Welcome back, everyone, to the None of Our Businesses YouTube show and podcast. With me here, as always, is Charlie Ziegman and AJ Wheeler.
What's going on, guys?
And we're gonna talk current events and business from an accountant's perspective, as always. And so, who's gonna kick us off this time?
I'll go first. Is that all right, Charlie?
Yeah, that sounds good.
Cool. All right. So actually, my first article here comes from a Deloitte blog post, actually, believe it or not. And it's kind of like their perspectives on like what COVID has revealed about remote auditing. So they have three major insights into the blog post is kind of broken down into three major areas that they kind of have learned from moving to like almost a completely remote auditing workforce. Now, I know like probably a lot of our listeners and you guys are probably wondering like what that has to do with us, because we're not an auditing firm per se, but also too, probably a small percentage of our audience is actually auditors. But I thought it was interesting because what they're actually talking about, I think kind of, encompasses everybody trying to move to a remote workforce. And I think it's probably good bullet points. So I'll go through them and then you guys can kind of give me your feedback on what you want. So the first big one is focus on what matters. And he talks about using the cloud, instilling agile principles, focusing on time management. And the last one is leveraging analytics and digital risk assessments. That's probably more auditing focused. Then the next one is make work portable across time and space. So emphasize digitization. That's a mouthful. Revisit the toolbox. So make sure that the tools that you're using are up to date and are able to be transportable via, if somebody's computer breaks down or something like that. Don't forget the data. So he's talking about backing up and data should be protected and all that stuff. And then move basic digital hygiene from the center to the field. So in the age of remote work, systems and networks require ongoing testing for security, connectivity. So I think he's more talking about like how to keep your systems up and running. The last one I thought was really good. Look to the human side of digital remote work. So it's like respect boundaries. So, if you have like a scheduled work day, not to constantly always have your devices on and being completely connected. It's actually something we talked about before we came on the podcast. Words matter to make sure that when you're, digitally speaking to somebody, I think we've all gotten like a text that sounds really harsh or something, but the other person didn't mean it that way. So to be able to communicate without voice inflections or, without the human side of a spoken word conversation, to make sure that your words are carefully chosen in your communication. Provide clear leadership. I think that goes without saying, to give people the confidence that, you're steering the ship if you're in charge of people. And then promote well-being, encouraging people to take time off, take time for themselves, take time out of their day for personal wellness. So I thought I'd like to get your guys' take, see if they missed anything or maybe if they're overly zealous in what they're talking about.
Yeah, I think I thought it was pretty thorough. And I think you mentioned this, that it seems like it applies to a variety of circumstances and industries where people are going to be working more from home and not returning right back to the office. I think one of the things that goes through my mind, the three of us who work together, we have this every week that we can get together and we talk a little bit before it. We do the show, and then we talk a little bit after. There's kind of a casual nature to it, and it's one of the things that we do that like keeps us connected. And I always think about that in terms of my leadership style in the companies I've worked with has always been to like minimize meetings and minimize a lot of kind of group activities, because it just feels inefficient and it's easier just to keep people on task getting things done. And I really felt in my attitude change a lot on that with this crisis and working from home. I feel like you almost have to go out of your way to create these touch points with your teams to have a reason to get together, even if it is just to say hi, how's everyone doing or whatever. I think it feels like it's necessary, and it helps kind of create that sense that we're all still working together even though we're working from home. And and because we don't have the water cooler moments or the moments that you're just passing each other in the hallway of a regular office. And so I think having some kind of way that you are getting together that isn't necessarily about the tactical work at hand all the time but getting together to communicate like this is important for this kind of thing.
I've heard some colleagues too do like a virtual happy hour, like a Friday where everybody gets in a Zoom call. And so I think that's an interesting point and probably something that like before COVID, I probably would have called it a dumb idea or something, or yeah, let's go drink on the company dime or whatever. But after it, I think it is really important for like team members to get together and see each other,
Totally. It's hard to like replace that water cooler thing. And in another article that I'm going to talk about later, but they talk about one of the things they did was to do a 15-minute stretching session every morning. So everybody in the company gets on one big Zoom call and just see the window view, and everybody just stretches. So that's maybe a little more of a different approach to it. But I think the article hit it right on with the technology thing too. I think we're all kind of lucky to have a system where most of the clients that we work with are already in some kind of online cloud type system in some way or another. But to just like imagine not having that and then still trying to work through this, it's really difficult. So yeah, I thought it was a good article. All right, so I've got another article we can talk about from CNBC called "Tech Companies Are Ending Leases and Consolidating Offices as Remote Work is Here to Stay." And so basically the article looks at what different actions companies are taking to try to get used to the fact that we're in the middle of a pandemic. And so for those that think it will continue, they're doing things like not renewing leases or trying to get out of their leases early. It talked about one company who had signed on for a 6-month lease with WeWork for 50 offices, 50 desks. And basically they were like, that happened right at the beginning of the pandemic. And so they went to WeWork and tried to ask like, hey, can I get out of my lease early, or what can you guys do? And they said, well, we can't do really anything for you, but if you sign up for another year, we'll give you a month free, which is kind of a silly like fix for the problem that they're facing. And so I guess I want to get your guys' take on, in that situation, is WeWork being the bad guy, or are they just using a lease the way that a lease is designed to be used? And this was all just an unforeseen event.
Well, I mean, I don't even think it's a matter of being a bad guy. I mean, if the lease is expiring and they're not even hungry enough to like make a better deal than just 1 month free, I think it's an example of a company that still, even though it's had its problems and didn't maintain as much funding as it might have, it still operates like too big and with too much bureaucracy and not enough common sense at the deal level, right? I mean, it sounds like something a really big company would do, that's not like thinking about what they need to do at an individual level, building by building. Because I mean, I don't know the specific building, the city or whatever, but you got to believe that they're going to have some major vacancies, right? So it seems like they should be cutting better deals to keep things going.
Yeah, and I also might mention it's no surprise that most of these ones that you're talking about are like internet or startups that are around technology companies. I mean, I think probably the majority of those probably should have been a remote work anyway, or at least online. I'm wondering what happens then with those services like I think of like psychiatrists or therapists, how if their need for a physical office is needed anymore, if you're doing like a Zoom therapy or something like that, or I think those traditional brick and mortar businesses that we've always thought about, like a service business, well, like a CPA firm. Do you really need somebody to come in person to pick up their tax return and go through it with them? Is it that necessary? Do you need a physical presence just to kind of show you're of that ilk, or you have that kind of? And I'm wondering if the public really sees that. So I also wonder about, there was these rent moratoriums and eviction moratoriums for people. I'm wondering if there's any extension of that goes to the business community. If you're trying to struggle along, sometimes your lease on a physical location probably drains your cash flow really quick in those cases. And just to circle back to WeWork, I mean, they're trying to post positive cash flow and, I guess, kind of bandage up their image after what happened with them kind of pulling their IPO and stuff, I would think that you would want to provide some kind of culture and newsworthy thing of where you're the good guy, in a situation like that. So it is an interesting thing that they refuse to give any kind of concession on that.
Well, especially because they're at a point in their life where they're on the cusp of something like pretty major. I mean, everybody's trying to transition to hybrid offices and stuff so that people have the option. And so it's a really good time to have good PR for if you are WeWork, So yeah, that was kind of surprising. Let's see, they were talking about other things that companies are doing to get used to it, are like recreating the water cooler moments by having every day around lunch, they'll do like a 15-minute stretch. Thought that was kind of interesting. Just interesting to think about. The other thing, I guess, is that they were saying that real estate as a whole is no longer going to be a worthwhile expense, is what a lot of the companies were feeling. And I thought maybe that was a little bit going overboard. It feels that way maybe right now, but obviously when you're talking real estate, it's such a long-term play that it seems quite a big statement to make, to say that real estate is not a worthwhile expense for companies at the moment. But
well, and if you carry that point through to the economy, if you believe that real estate's not a worthwhile expense for businesses, then there's some doomsday videos out there. If you go look on YouTube for that guy Robert Kawasaki, the Rich Dad Poor Dad guy, and other people who are talking about that's what they see, that's what they expect is happening, and in fact that's going to lead to a crash in the commercial real estate market, which will have its own kind of significant impact on the economy as a whole. But you look at the entire downtown areas of high-rise office complexes that aren't going to do well in terms of valuations, because renters are leaving, and residential real estate should do well and continue to do fine. I think overall the data was showing that residential real estate might have been down, but then at the same time, from what I've heard, there were markets where things seemed to be up a bit because people were leaving the cities and going into the suburbs and rural areas where they could kind of get bigger property and stretch out a bit because they knew they were going to be spending a lot of time at home, kind of thing. So yeah, I think there could be a longer term trend away from downtown condo living and downtown residential living, for a trend away from that, and there could be a trend away from commercial real estate in general, and that may have more profound economic effects than just whether individual businesses are incurring that expense.
I might mention, it's just my thought, but and I probably don't. But I remember do you remember the Superman movie, when they redid the Superman movie, when Lex Luthor tells them, land, it's the only thing that they're not making more of. So, I mean, it's one of the most finite resources we have. And I think to basically say the real estate market or the commercial real estate market is going to blow up, I think underlies the fact that there's only so much square footage, around that you can build in and have offices or even like residential areas. And to kind of plant the flag that real estate is a dying business, I think that's a pretty big jump to take, that I think, and I think this goes back to what we've been talking about, a crisis or a pandemic is never waste a good crisis. If you're in commercial real estate and people are clamoring for places to live, you might want to pivot into residential and changing those areas that were once traditionally a business park or something like that into residential areas. And this also isn't unprecedented. Back in the 80s with the explosion of strip malls, I mean, there were just too many strip malls for the amount of businesses that wanted to be there. And then you had an economic crash and the recession in the 80s that caused a lot of those to be vacant. And so I don't think it's it's not uncharted territory for real estate to have gone through this. And I think you could probably look back to that time of a commercial strip mall explosion, and then there being too much demand or too much supply and not enough demand. And I think you're probably going to see the same thing here.
I think that's exactly right. And so I think kind of another way of thinking about that is it's all in the time horizon of whatever decision you're making. So it's like if you're a company that is looking to, do something with real estate in the next year, that's questionable, right? It doesn't seem like it makes sense. If you're making some kind of 30-year play, then, this plays into the radar a little bit less, I think.
And I also might want to point out, owning real estate in business is much different than owning real estate in personal life. A lot of businesses go through their entire lifespan without owning a piece of property. Leasing and like renting is probably more commonplace in a business than it is to actually own a piece of land.
Totally. And one of the points it made in the article that I think points to that really well is that they said that a lot of people are saying, well, if people are stuck in their leases, then that's going to mean that subleases are going to become really popular, and so they can get cheap subleases, which just fits exactly into what you're saying, which is that that's normal for them to both do that and to be the customer and the seller. So yeah, you got another article we can talk about, AJ?
Absolutely. So the next article I have is actually it's the online. This is from Forbes. This is the online banking insurgency of 2020. So basically, what this is it's talking about the fintech world of kind of moving in on traditional banking, and basically the blind side of the actual blind side that they've seen from traditional banks or brick and mortar banks to this move to like an online banking kind of thing. So according to a study that they did from Cornerstone Advisors, just 20% of bank executives think online or digital banks are a significant competitive threat. So, and they're talking about big tech, mega banks, credit unions, large fintechs like PayPal, Credit Karma, digital banks like Chime or Vero, and then community banks. And so that was a July 2020 survey of U.S. consumer advisors found that 6% of U.S. adults with a checking account now consider a digital bank to be their primary bank. And that's a 67% jump from just January of this year. And so what they're showing is like they kind of list the major players in that digital banking realm: Chime, Dave, Ally, Varial Money, and they kind of give you the users, number of consumers that consider digital banks a primary bank. Chime has over 4.3 million users in their bank. And I thought that was a pretty significant number. So if you look at then the number of consumers that consider their bank their primary bank, Chime is, I think, the first fintech one on the list, and it's up there. It's actually it's like the 9th bank listed on that survey. So Chime is now in the top 10 of U.S. banks, and it's a completely digital offering. So I'd like to get your guys' take, whether or not we're going to see, and I think we are, my personal take here, spoiler alert, is you're probably going to see a banking influx of these fintech where it merges kind of the online platform and we've talked about this before, but basically an all digital bank where everything is ACH or, wire driven, and basically your life lives, there's no more cash basically in this world. You're making remote deposits, you're making transfers, ACHs. So I'd like to get your guys' take on whether or not you think banks are being blindsided by this, and maybe it's just the age of the executives that are causing this, or if you think there's still a place for like a brick and mortar walk in the front door bank these days.
Well, I got to say two things. I mean, I love this topic. I'm really biased because I've managed the finances of a company that's been kicked out of a big bank and had to switch to online banking. So that's made me a little bit biased. Or not online banking, because obviously everybody does that. But I mean, a bank that didn't have physical presence like you're describing. But the second thing is I'm just a big nerd. And so basically using all the websites and, that kind of thing, and having online tools that integrate with your accounting systems better, for me, those kinds of things are what matter. And so that's always driven, these digital banks tend to be better at those sorts of things. I got to say, after moving from Bank of America to some digital banks, I've had nothing but really good experiences with all of the other ones. And on a lot of things that I had reasoned initially that Bank of America was the only one to offer the service that I need, and found that, hey, actually, if you just go look, like you said, there's all these other guys doing it. There's Chime, there's all these other options. And so, yeah, I think it's a trend that's going to continue on. And I'm a big supporter of it.
Yeah, I mean, I don't think it's blindsiding the big banks, or at least they really don't have that excuse, because it's been coming for a long time. And banks have had the benefit of a regulatory moat that makes it difficult to become a bank, online or otherwise. And so early on, when fintech wanted to start banks, they had the technology to run the front end of the online bank was there far sooner before the ability to actually meet the regulatory requirements to actually start a real bank was there. And so I haven't studied this issue, so I don't know, some of these companies that you're talking about, if they truly are full banks in and of themselves now. But I know, like 5 years ago, for example, we had a startup here in the Portland market that was exactly like that, called Simple Bank. They were designed to start up as a digital bank, but they weren't able to go to market immediately as a full bank themselves, and so they had to ultimately partner on the back end with a regular large commercial bank in order to make that work. All they could really be was the front end to that digital bank, and then over time, I think they eventually, the company, after it started up, got acquired by an actual bank as well. And so I don't know the status of that company either, but I imagine at this point there are some of these fintech digital banks that have done what they need to do over time to become full-on banks in and of themselves. But that's been kind of a hurdle for this industry to like get going as an online-only digital kind of system. And that goes back to my original point. The banks had a lot of lead time to this coming because the digital players were out front trying to do what they could before they actually had the capacity to have real banks on their back end. And so if they're actually coming to the table now with the full enchilada, it's been years. I mean, banks have had years knowing this was coming. This has been in the works.
Totally. I agree. All right. So
I'm wondering if this isn't I think probably what we're going to see out of the pandemic is an acceleration, because I mean, I can just speak for myself. I don't use a physical bank except for in the rare occasion when I need to go yell at somebody or get a notary service, like that's probably the only time I ever set foot in an actual bank. And I think competition is a good thing. And I think if you have banks offering these, like Chime, for instance, offering these very low fee, no cost, where they make the majority of their money off of the transaction fees, basically on bank transfers and wire fees and all that stuff, I think you're going to see an explosion of good competition. And I think it's going to be good for businesses, period, because I think it's going to drive the cost of banking down. And I think it's going to make it available to, and provide competition, especially in like small rural areas where probably you only have a few choices.
Yeah, the other thing that I want to add here too is that there's been an insurgence of alternatives to banks. Not just, we're talking right now about physical banks versus digital banks, and that's fine, but there's a whole other layer too, which is the act of a money transmitter in this whole story. And there's been a bit, it used to be that Western Union was the big money transmitter, and so it was seen as this, like, I don't want to say niche industry, but that was all it was. But with the explosion of all these online and international payments, there's been a bunch of companies that have kind of sprung up out of the woodwork that aren't full banks, but try to offer the same services that a bank would. And a lot of them are getting pretty close. I mean, they have debit cards, they have a lot of different options that you wouldn't associate with someone who wasn't a bank. So yeah, I just thought that was interesting. But while we're on the topic of kind of banking and technology, I found an article in Accounting Today called New York State Accuses Tax Prep Companies of Hiding Free Software. And so basically the New York State Department of Finance has basically put out a report that said 5 tax prep software companies are hiding the free version of their software, even though they're part of the Free File Alliance, which is basically the IRS. It is basically a group of tax prep firms who said they were going to offer free filings to individuals who had an AGI of under 69,000. But then what's happened in reality is that these companies say they're going to do that to offer the free filing, and then they'll do a few things. They'll either change the rules so that it's only for people who make under 40 grand or 39, or actually 36. And then the other thing they'll do is they'll just hide the landing pages. They'll just make it so that, like, when you try to Google TurboTax free filing, it just doesn't show you that. It just directs you to their to their cost service. And so I guess I want to get you guys' take on, is it disingenuous to offer to be part of the Free File Alliance and have a free file option, but then bury it using search engine optimization or just by bad web pages? You guys think?
I think it is kind of sneaky, and we've talked about this on the podcast before when we were talking about the Intuit TurboTax kind of lobbying to keep the free tax filing out of the federal government hands. Because let's be honest, I don't think it would be that difficult for the IRS to build something out where you would basically, they already have like a lot of your information coming in electronically under your social security number. And I don't think it would be too far of a stretch of the imagination that they could devise a system where you log in, give your social security number, and a lot of your information is already pre-rolled and filled into a tax filing form. So, I mean, they already offer digital fill forms, on the IRS website. But what has happened is these lobbyists for these larger tax prep companies have basically lobbied against that, and given the promise that they would still offer these free tax filings for people that are below a certain threshold in AGI. Now, the other part of that they don't mention, and I don't know if they mention in the article or not, is that that doesn't include a state filing. So if you have a state income tax and you want to file that, you either got to pay to print it out and lick a stamp and send it into your state, or you got to pay a convenient fee of $25 to send that off to e-file it with the state. And so it's kind of, I think it's kind of a matter of time before somebody gets fed up. We've seen open source software work as like a competitor to Windows. So Linux, for instance, is an open source software. We've seen it in the like how Microsoft 365 kind of moved to a subscription base. I think in part that was probably due to like the open office culture of where they have free open source software that has an office suite that can compete with a Microsoft Office, even though probably most in business pay the fee because Excel and Word are probably the permanent used software. But I think it's only a matter of time before there's an open source, alternative to this that's made available for free. And I think that'll probably be the changing point. That's just my personal opinion. And I think the open source software community has done a lot. And I think maybe that'll be the breaking point. Either that or the lobbyists will not get through and this becomes a hot button issue and the IRS goes ahead and does it. But it doesn't surprise me at all that these companies kind of hide that behind there because this is how they make their money.
Yeah, I may have a sort of unique view on this, but I think what people have to consider is what did the companies really agree to in this whole thing? Did they agree to create the infrastructure that would allow for free filings, or did they agree to actually provide a service to the community and ensure the community and distribute that service, right? Because really, I think what we're faulting the companies for is that they're not providing any kind of distribution, right? They created the product and the infrastructure's there, but they're not doing anything to distribute that to the people who need it, right? And I think arguably they could fairly argue if that wasn't really what the intention was of this deal, they could fairly argue, well, shouldn't the government do what it takes to advertise and drive traffic to the free services? We created the free product. It wasn't on us to distribute it as well, right? And I think about that in the context. I mean, that has special meaning to me because I like to garden. I garden really big, and so I grow a ton of vegetables, things that I can't personally eat everything I grow. I just like to grow a lot, and so ideally, what I'd like to do, and what I do like to do is get those extra garden vegetables out to people who need it, to food pantries, and to people who where it can be distributed. But there is a distribution problem there, right? Because it's not enough for me to just grow extra vegetables and then pat myself on the back and say, okay, I grew it. If the tomato is still on the vine, it doesn't actually help anyone, right? I can grow a ton of vegetables and that I can say, well, the excess can go to anyone who needs it. But if I don't have a plan to actually distribute it to them, it doesn't do anything, right? And so there's two other steps. I mean, I not only have to grow the vegetables, but I actually have to harvest them and process them and wash them and package them. And then I have to actually take them to a food pantry in order for this whole thing to even work. Otherwise, the intention of just giving away extra vegetables doesn't go anywhere. And I think that's similar to this kind of deal. And so because I know those different steps, it makes me wonder, like, what was the intention? Or because as the public, we're looking at this situation and we're assuming that the intention of this whole deal was for the companies to do everything in that distribution chain, from creating the product to harvesting it and distributing it to the public. And I think that might be their pushback, is that wasn't the deal. They created the product, but somebody else should have been doing the harvesting and distributing here.
Well, and even if the IRS couldn't handle the advertising for it and get enough eyes on that product, one could say that maybe they should have just written the terms of joining the Free File Alliance a little more carefully, so that's things like search engine optimization to drive people away from that product were written into the rules. You could say, if you want to be part of this alliance, you're not allowed to game the search engines. And that seems, but just to put it in context, one thing we didn't really talk about is that basically 2.5 million out of 100 million people who are eligible used it. And so it's definitely not the intent, or at least not in retrospect, the intent that they set this up. They started an investigation to determine why the use rates were so low. So I think they had envisioned it being used a lot more. And I don't think it was just to get the option out there. I think the intent was to actually get people to use this tool and really provide a service, but that's debatable,
Well, and I might mention then that really falls, and I can't believe we're talking about it, but that's a marketing thing, right?
Yeah.
And we all know that the IRS and the government aren't good at marketing because they already have a free in-person filing for low-income individuals. And we all probably know about it because we're in the accounting field, the VITA program, which provides free in-person tax filing for low-income. Well, actually, you can be anybody and walk in there and get free tax filings. But in Oregon, it's marketed through the AARP and another organization called Cash Oregon that provides these like satellite offices to prepare taxes. But the marketing behind it is garbage. I never knew about it until I was in the accounting program at
Me either.
State University. I would have never known about this program. And a lot of people that find out about it are either returning customers or word of mouth, or they're so old that they really don't need to file one and they get a notice from AARP because they're signed up to that. I don't think it's surprising. I think it's surprising that they wouldn't write some kind of marketing thing in there or some kind of way that this is to be delivered, that it's probably just written that they need to offer this. And so I think probably that's where the disconnect is between the marketing of it or the availability of it.
Yeah, I mean, right or wrong, I mean, that is the case here, is that these companies clearly have not taken responsibility for marketing and distribution of the product, right? And that's what we're faulting them for. And I just say, well, yeah, okay. I mean, I think on one hand, I can agree with faulting them from the standpoint of they themselves, Intuit, should recognize that creating a free program does nothing if there is no marketing and distribution. So you can't pat yourself on the back for doing anything good there unless you're part of the solution to actually get it to the end user. But on the other hand, it's like, if that wasn't what they agreed to do, if they didn't agree to take that on, they didn't agree to take that on. And I think the discussion about the search engine optimization to me feels a little bit fickle, because let's face it, that is what search engine optimization does. It channels users to the paying product of any company. It channels them away from competitor products into the paying product of the company. There's no, if it's not Intuit or the company's responsibility to basically market the free version, there's no reason why they should run their search engine optimization in a way that would allow people searching for their product to go to the free product versus their paid product, right? It makes total sense that if you're spending money on the marketing through search engine optimization, you would spend that money on channeling people to the paid product when it's not your responsibility to just market and distribute the non-paid product. So I think it really does come down to that. I mean, they can come up with all kinds of with reasons to kind of point the finger at the companies, and on one hand, like I said, I kind of agree that the companies aren't doing, they can't really say they're doing public a favor or anything with this, but at the same time, I don't know that it was their responsibility to market and distribute this anyway.
It probably goes back to what we've said a long time ago in this podcast regarding the PPP loans. If you wanted this to be marketed and available, then you should have wrote a better contract. the contract with these companies should have been better defined to include marketing and to include like a target number of reach for the clients or for the filers that they wanted to touch or have the returns provided for.
And I do have to mention, just out of full disclosure, that they found in the article that it said last December IRS revamped the program to try to make it easier to find, but I think it's still not what it should be. And so I think you guys have it exactly right. But I think they're trying to do that. But like you said, they're just not good at marketing, so they don't know how to write the law in such a way that it really works or achieves its end goal.
All right. Next article I've got is another one from Forbes. So this is what recent Axiom, Deloitte, and United Lex announcements reveal about law's future. Now, this is kind of related to an article that we talked about last week where Deloitte is offering now law services, I guess, or like a law kind of consulting arrangement that they've kind of launched this new arm of kind of like like they would advise on financial services, they're now advising on law services in big companies. And if you don't know, a lot of large companies have like a chief legal officer, I guess, is for lack of a better word, somebody that oversees contracts, labor disputes, yada, yada, anything legal that deals with the company, this person is kind of in charge of. And so basically what's happened is Axiom hired a new CEO from a Gartner. Deloitte launched this legal business service offering, and then United Lex hired a chief digital and transformation auditor from a GreenPag. But basically what they're saying that ties this all together is that big money is betting heavily on business and tech-trained leadership to guide legal service providers into the digital age. And I think the reason why I brought this article up is because I think it's interesting. We've talked about before on this podcast where like the CFO role of large companies don't need to be, or I guess the statement that one of the articles that we've reviewed in the past was they don't necessarily need to be a CPA. What they need to know is how to bring in private equity. They need to know how to present to a board, to present to investors, to shape the message of the financials, to oversee the financial kind of picture of the company, but they don't necessarily need to know credits and debits, IRS law, yada, yada. That's kind of put off to the person right below that in the company. And I think we're seeing a change in a chief legal officer or the person that's the head of the legal department in these large companies going the same way. And I kind of wanted to get your take. Do you think this is going to be a continuing trend for like CFOs and for chief legal officers, where we're going to see a kind of a shifting change to where they need to be more rounded and well diverse and maybe come from different backgrounds in this area? Or do you think this is kind of a fool's errand where they really should be laser focused on legal services, or in our case, CFOs being laser focused on the true accounting of a business and not so much on the other soft skills and sales skills that they talk about are wanted for these positions?
I mean, I think if the regulatory environment will allow for it, then of course companies will look for ways to have broader options than just lawyers who are registered with the bar associations of their states, right? I mean, that's the issue with the CFOs. From my perspective, if you ask why is it that more companies have CFOs that aren't certified? It's because businesses like options, right? And so, if you can, which you can, there's really no legal or regulatory reason why your company's CFO has to be a CPA or a CFA or a CMA or any other kind of specific certification. And since you can do that, then I think it's just natural for businesses to basically widen their berth to look for, because really in a hiring, like all other business decisions, in a hiring decision, you're looking across the broadest variety of options you can to get the most expertise for the least amount of money, really. I mean, it's weird to say that about hiring because we also say in hiring that you got to pay for the right people, and that's true. But still, hiring is a competitive market, and so you want to the less restricted you can be as a company on who you're allowed to hire for a certain position, the better. I don't know enough about legal services to know where this goes for chief legal officers, because what I do know, the background to some of this issue is that what's unique in the United States compared to Europe is that the bar associations in the United States will not allow lawyers, people who are actually authorized to practice law, they're not allowed to share fees with non-lawyers. So what that means is that you cannot have a firm where a lawyer is practicing law be a partner with an accountant who's not a lawyer, and that they're sharing fees as equity partners. That's just not allowed under bar association rules in the U.S., where it is allowed in some other countries. And so that's a big difference. And it's a racket to some extent. I mean, I'm sure the lawyers in the bar associations will say, well, that's because of ethical reasons why we've got to do that. But it's a professional racket in the sense that it doesn't generally work the other way. The only place where CPAs and accountants have a similar monopoly is, or a similar franchise, is specifically with assurance services, with audits, reviews, compilations, and so on. Only CPAs can do those things. But all the other broad variety of accounting services, whether it's anything from bookkeeping to tax prep to management accounting to being the CFO, whatever, lawyers can do that. Lawyers can sign off on tax returns without any other further certifications, right? So it's so I've always felt it seems a little bit one-sided and unfair in that regard. But so they've got to thread the big four firms or other firms who are not law firms and they're not lawyers under bar association rules coming in and providing quote unquote legal services. They have to thread a pretty tough needle there to make sure that when they're talking about legal business services, they're talking about the clerical supporting services. They're not talking about something where they would be delivering a legal conclusion. I suspect. I'm not a lawyer. I'm not an expert in this area, but I think that's what this revolves around. And so to your question about the chief legal officer, I don't know if you can reasonably be the chief legal officer of a company without signing off on ultimately what the legal conclusions are for various items, right? That sounds kind of weird to me. I mean, but I can imagine you could set up a system like that, right? I mean, because your CEO doesn't have to be a lawyer, and even if the chief legal officer was a lawyer who then recommended a legal position, the CEO still will sign off or not on it without being a lawyer. So I imagine you could kind of set something up like that where the chief legal officer is like this super administrator, and they are not purporting to actually provide any kind of legal conclusions. They're relying on the legal conclusions of outside counsel or of inside counsel who actually are lawyers, and that there's somebody on their team who is the official professional who has the last say in what the legal conclusions are. Maybe something like that can be set up. I'm just brainstorming on how these things could be figured, but I don't know. Like I said, I think it's a tough needle to thread. They're obviously threading it in some way to make some money here. Good for them, but yeah, it's not. It is a little bit tricky. So I think it remains to be seen how this goes. And I bet you the bar associations around the country, I think they're divided by state. I think those bar associations are probably sitting on there, are just sitting and ready to pounce. They're ready for the first company or first consulting firm doing this stuff to make a mistake that they can pounce on and try to drive this away so they can protect their franchise.
Well, and I know this is a little different, but the other thing is that, there's that site LegalZoom that has basically tried to take the idea of a lawyer and automate as much of it as possible to put it in the hands to where people can go in there and draft their own documents. And that is, again, a different service, but it's the same idea of taking an age-old industry such as law and kind of turning it on its head by seeing, hey, what parts of this process can we pull out? And if nothing else, it allows people to do the drafting and then get, like you said, get a legal review and, just make more efficient use of that legal service. And so I think that it's going to continue to be a trend of just what parts can we pull out of this process and how can we make administering law and contracts just easier and easier.
I think that is a great analogy, and I suspect it is kind of like that. I think it is of that nature of, at what, and again, I don't know exactly how they parse that in a way that makes it legal and work under the bar association rules to, at what point is providing legal advice versus just providing a template. That I'm sure there's all kinds of really technical jargon and things to know about doing that. But yeah, like you said, we'll see where companies are able to go with it.
All right. So if you guys are open to it, I've got a whole different angle we can go on this whole podcast news article business.
I'm excited about this one because I've got some input on this one. So
Good. All right. So I thought, we're doing all these articles, and right now the news is full of COVID. Like, you can't read news articles right now without reading about COVID. And so I wanted to kind of get away from that. And so I looked around on a lot of different websites, and there's just so much of it that I decided it'd be interesting to go look at Wikipedia and see if we could find any articles that were interesting to discuss. And one that I think, one area where accounting and kind of the everyday world overlap is through Hollywood accounting. And what this is this is the, and I'm going to quote here, this is the opaque or creative accounting methods used by the film industry to budget and record profits, wherein expenditures can be inflated to reduce profit and thereby reducing the effect of profit sharing agreements. So to put that into layman's speak, it means that people who sign on to do movies as actors or as studios or whatever role they play often sign up into an agreement that is basically a sham. It's basically saying, I'll give you a bunch of this profit that will never happen because I'm going to control all the components of the profit to ensure that you never have any. And there are some pretty notable examples of this. For example, Return of the Jedi earned $475 million and had a budget of $32.5 million, but according to Wikipedia, has never gone into profit. I mean, isn't that just amazing, guys? And so kind of the way that they do it is that there's a lot of ways that they do it, but one of the ways they do it is they set up deals with the distribution arms or with different services that are being provided into the studio, and then they just set the control over how much gets charged. So basically by shifting all of the profit to one of their sub-entities, which wasn't party to the original contract, it just then, results in them getting nothing. And so the other interesting thing is that they said that points are often referred to as monkey points because they're just meaningless and it's, like a carrot on a stick. And when I say points, I mean the idea that you're going to agree to receive like 1% of the profit of a film. And so, yeah, there's a lot you could say, but I want to get you guys' take on, do you think this should be more heavily regulated, or does the blame for this fall on those who signed into that contract? Because this is not a new thing. So
actually, the first time I heard about Hollywood accounting was on the Joe Rogan podcast when Bill Burr was on there discussing Joe Rogan's like blockbuster Spotify deal, where he's going to move away from his main podcast being on YouTube and sign basically an exclusivity deal he owns the show still, but he got like, I don't know, in between $150 to $300 million to have the sole distributor of it be Spotify, and it'll be available on there. Now he'll continue to have the clips where it's the small, like bite-sized pieces of the interviews on YouTube. But I diverge here because what Bill Burr was talking about, and the reason why he got so heated about it, was that he was basically putting out an all alert kind of bulletin to any young comedians or creative types out there, not to sign deals that give away the core, you want to still own the product. So like if it's the podcast, you want to have rights to the podcast itself. You can let them monetize it or, like have rights to air it or whatever, but never sign away your art or your, the base of what it is. And he then got into a conversation about how he had tried to get TV deals or show deals and the weirdness of Hollywood accounting. And the way that he explained it was they would present you with a contract that had a 60-40 split, meaning they would handle the producer or the distributor would get 40% and you would get 60%. Now, what the fine print read was that they got 40% of gross revenues and you got 60% of net revenues. And so what would happen is they would, you made $2 million right off the top, they would pull the 40% of $2 million. But then they would add up all the expenses that went along with that, and you would only get the net amount of that. And so it was funny because he was trying to get a TV show made, and one of the items that he said he was being charged for was $2,000 a month for copier use, like a Xerox copy machine. Now, the lease for the guy probably doesn't even own the copy machine. The lease for the copier is probably $2,000 a year or whatever it is. But he was having to deduct that from the amount that he was getting used. And he was saying that they didn't want to make copies of anything. that they would go down to Kinko's and pay for it themselves. This was a low budget trying to get it on the screen kind of thing. And I was unaware that this even happened. And I think, to your point, Charlie, I think it really denotes having like an above the board manager, an above the board accountant on your side, and how a lot of these guys, they've never seen money. They've been a struggling artist for a long time, and they hear 60-40 split and they think that's a great deal. You know, they're going to handle all the accounting and all of the legwork for this, and I get 60% of whatever this makes. And so I think it is fishy, and I think I think that probably the internet has at least curtailed some of this in the last 10 years, but you're going to see an onslaught of them trying to claw back into it, because on that same podcast, he had mentioned that there's been young comedians that have a podcast and have been approached, and basically they want to own the podcast and give them a percentage of it because they'll handle all the marketing and legwork behind distributing the podcast. When in fact, like, you're already doing that yourself, and you should own, you know, your art and be able to make money off of it, even if it's less than what you think you should. So I don't know. I'd kind of like to get Ty's take on this, if he's ever heard of Hollywood accounting or the structure of those kind of contracts, if he has any input on it.
I haven't heard of Hollywood accounting per se. This was new to me and interesting, but the concept of having an entity where you have like an operating partner and you have investors, and the operating partner looks like in that agreement that they make a certain percentage of the profits, and the investors get another percentage of the profits. And often this, even in the other kind of commercial business setting, this looks even more appetizing to the investors. Like, the operating partner will seemingly have a very low percentage of the profits from that business. They might say something like 10%. The operating partner is a 10% owner with 10% of the profits, and the investors are 90%. But then it turns out that the operating partner is also a management company that supplies a bunch of services to the joint venture, and really that's where most of the money goes out the door in the management service contract. And so there's not really that much that hits the bottom line to be split 90-10 anyway. And we see that happen across a lot of industries, energy developments and other kinds of businesses. And I think it's just a matter of, sophistication of the partners, understanding their operating agreements and understanding where the money's going to go and what the profit projections that you'd be splitting actually might look like, and what kind of controls are around that. So it is interesting. I do see in other places, but if I were to pivot into kind of the regulatory aspects of this, I think Charlie mentioned that idea, that question of, well, should this somehow be regulated so that creatives, for example, in the creative industry, can't be taken advantage of by kind of slick business people or legal wranglers who create these kind of arrangements. And I guess that's a very interesting issue, because I think what you see in this particular industry is you see this kind of tension in this bias that we have in this country. And the bias that we have in this country is this idea that if you make more money and you have more money as an investor, or you make more money, that must mean that you have some level of sophistication in business. And so this even goes into how accreditation rules work for whether you're allowed to invest in private companies, right? If you have a certain net worth, or if you have a certain income, then you can be an accredited investor, which means that the SEC will allow for you to be an investor in a privately held business. If you're not an accredited investor, then you may not be able to be an investor in a privately held business, or that privately held business may not be able to ask you to be an investor because you're assumed to not have a level of sophistication about business matters that would, and you could be taken advantage of, right? And so we've linked in our culture, this idea that if you have more money or you make more money, you have a certain level of sophistication when it comes to business. And I think show business is like the hallmark example. I'd say that, and athletics and some other industries, and certainly they aren't the only ones, but at least those two businesses are great examples of where you can have people who make phenomenal amounts of money, but you wouldn't reasonably expect to have any business savvy or necessarily have a lot of sophistication of business. I'm not saying all actors or models or athletes don't have business savvy. We know, and there's plenty of them out there that do, that become investors and become business people and are really successful at it. They develop business savvy. But in general, it's possible to make a lot of money in those industries and never really have a lot of business savvy. And so it's kind of a weird, that creates this tension, right? Because that's possible, yet our cultural norms are to assume that if you make that much money, you must have business savvy. And so I guess the alternative assumption is, well, if you make that much money and you don't have business savvy, at very least you're smart enough to have people around you who do have business savvy, right? And you can hire those people or whatever. So that's the expectation, really, right? And so when it goes to this regulatory thing, I would say, no, I'm kind of against regulation. So I'd say, no, I would not favor regulation to protect creatives in that regard, because that's a slippery slope. It's like, okay, so, do we create regulation to protect people with potentials for very high incomes who don't have business sophistication? I think while it's imperfect, the current social expectation that somebody who has the potential for a high income either has business savvy or finds somebody to partner with who does to work with them. I think that's the right methodology for now. I think that's the best we can really do.
Okay, so in the example that AJ set up of the copier, for that, I agree with you 100%. I think if you're not wise enough as an investor, as a person agreeing to a contract, to realize that some copier you're signing up for costs too much, then I think that is a level of business savvy that I think I would expect, those people to have. But in the article, one of the things it talked about was that there's a thing called a reverse Tobashi scheme, where a studio cross-collateralizes the accounting of two projects in order to shift losses from one flop project onto a profitable one. And so the reason I bring that up is because I think it's one thing to have business savvy and know what you're reading and agreeing into. But the thing is, that specific type of scheme that we're talking about is so far beyond business savvy that even, it doesn't matter what as that scheme is so shisty and so illogical that we can't expect even professionals unless the rule is written in a way that stops it from happening. I guess I can't imagine that there is a realistic way to have stopped that specific issue or others like it, because it talked about how the levels of complication of how they administer these are so in depth that I think you're 100% right most of the time with a business savvy thing. But I think in this one, it's just so crazy and illogical sometimes that even with that, short of not getting into that contract in the first place, I don't know how to stop that type of problem.
Yeah, I think there's two possible directions to go with that argument. I think I would tend to agree with you on that, though, Charlie. Is I would say, okay, yeah, if you've got schemes that are designed to basically even to really thwart and fool kind of people taking reasonable steps to have a business manager or a lawyer, and these schemes are designed to even bypass those things, then it's like people are really trying hard to take advantage, and I don't think just buyer beware necessarily is the right philosophy in that case. I would agree with you that it seems like those case by case scenarios can be regulated, and maybe should be looked at and regulated. But I would put it the other way because of the last part of what you just said, which is, or you can just choose to not get into it. And as if I'm the business advisor of a high net worth person or a high income person, and we're looking at a contract like that is so complicated that even I can't understand it, that would be my advice. It'd be like, there's something fishy here about the reason why is this so complicated? I'm a pretty smart guy. I've seen a lot of different things. If I can't understand this, there's something up here that doesn't smell right. So, I can't tell you for sure it's not good, but maybe you should pass on this one. That would be the right business advice, right? And so
And so I think it's still not the case that even in that scenario that you can't be protected by it with good advice, because the good advice would be to just not do that deal if it's that complicated.
That's true. I think that makes a lot of sense, because if you can't understand it, you shouldn't agree to something you don't understand. I'm with you on that 100%. The only other thing I wanted to add that I caught that was interesting was just that Michael Moore sued Harvey Weinstein over Fahrenheit 9/11 in 2011, and it was settled. And I didn't realize that. I didn't know that, but I think it was over this issue of Hollywood accounting. And I thought that, that would be an interesting tidbit.
I think it follows our advice that we've always given on this show is if you don't have the expertise, you need to find somebody with the expertise. And if you're one of those young creatives that's ready to sign a contract, you're at a point where you need somebody on your side that you can trust and that can navigate these waters for you. And I think that's the biggest takeaway from all of this is you either need to talk to somebody that's been there before and has gone through this, or you need somebody on your side that you've hired that has your interest in mind and is able to read through these things.
I agree, 100%. You have to have somebody in your corner who knows what they're doing. All right, everybody, thanks for watching. This has been the None of Our Businesses podcast. Please hit the like button, comment down below if anything we said frustrated you, and come back again next week for more of what's going on in the world of business. Thanks, everybody.
See ya.